There is a ton of inherent value in today's video, not only for folks looking to get into trading options, but also just if you're trading equities, it's imperative that you understand how to read the options chain, because the options chain provides you with a ton of information about the future expected value of a ticker. Not only are we going to go over what you see on your screen today, but also what each thing means. So if I begin talking about delta, gamma, theta, vega, implied volatility, and you have no idea what I'm talking about, congratulations, you're going to learn something in today's video. Hit the like button for me, and we'll jump into it. We are going to be inside the Thinkorswim active trade software provided by Charles Schwab today, but that's okay. If you use a different trade software, your options chain may look a little bit different, but all the information we're going to go over is the same across all options chains. So it's okay if your UI looks a little bit different. You're still going to find value in this video. But how to navigate to this screen within Thinkorswim, you're going to click on your trade tab here, and then you're going to be under the all products sub tab, and that'll take you to the options chain. We're going to go through this page top down just so this video is easy to follow. Your top section here is named underlying. All of these completely collapsible, of course. And this is just showing the statistics of whichever ticker that you have typed in. Of course, you can change tickers just like anywhere else in Thinkorswim. From this box here, you are now seeing the underlying price, change, bid, ask, etc. of NVIDIA. If I jump back, you are now seeing the underlying price statistics of SPY. This can also be expanded for a little bit more detailed fundamental analysis. Normally not needed, but there just in case. The next section down is called Trade Grid, and if we expand this, you will see that it is a level 2 of the current ticker. Also, you can click on these cubes here, and you can show multiple different tickers within this. So say I want to look at NVIDIA's level 2 and Tesla's level 2, just so from this one screen, I can get an idea of price changes of specific tickers so that in case I want to switch and go trade NVIDIA quickly, I can do that. Once again, I'm not hardly ever using this section, but for the sake of covering everything in the video, that's the trade grid. Alrighty, what are we, 2.5 minutes into the video, and we are down to the meat and bones now. We are down to the options chain. Thanks for sticking around with me. Let's jump into what you're actually seeing here within the chain itself. So, a couple of things to go over first. There is a filter section in which you can use to filter to look at specific things. I'm not going to dive too deep into what these filters mean. I'm not going to insult your intelligence too much. Come in and play around with them if you would like to. Next, there is a spread. If you don't know what option spreads are, at a very high Eli 5 level, they are buying typically one side of a trade at a certain price and the other side of a trade at a certain price that you are looking to play specific types of moves rather than just buying calls and hoping the stock goes up or buying puts and hoping the stocks go down. That's what single options are. If you buy a straddle, just for an example's sake, you are buying calls and you're buying puts and you're making money if the strike price, if the price of the ticker, remains and expires between the middle of those two strikes, calls and puts that you purchased. And there's all kinds of different spreads you can build. If I click on straddle though, you will see it is showing you the price and the strikes that you would buy of the straddle. If this is an options 101 video, talking about option spreads and stuff is more like options 401. So I'm not going to dive too deep into this video. I just wanted to make sure that you understood what it was. Next, you have your layout here. So right now we are looking at delta, gamma, theta, and vega. And there's all kinds of different layouts and different information that you can see on your options chain. And we are going to click through all of these in just a moment after we cover the rest of what you're seeing here. If we continue into the middle, you will see strikes. This has a drop down. This is just showing how many different strikes you are seeing on your chart, how expanded the chart is. If I go to all, you will notice how crazy it goes. And I should also note that you can type anything into this. So if you want to type in 9, you can type in 9. All right, let's jump down to the actual chain itself. First off, let's talk about the colors. The blue here means in the money. So calls, this is a little bit a little bit below this video. But if you don't know, calls mean you are reserving the right to buy the stock at a lower price, so you make money if the stock goes up, right? Vis-a-vis the current price of Nvidia is 703. So anything, and this is the strike price, which if you don't know what that means, I'll get into detail just in a little bit. But anything over 700, anything, what am I trying to say? Anything below 703 is going to be in the money for a call, right? Whereas anything above 703 is going to be out of the money, thus colored black. Puts, obviously the exact opposite. You are reserving the right to sell shares at a certain price. Vis-a-vis, you make money if it goes down. So anything above 703 is going to be in the money for a put. Anything below is going to be out of the money, thus colored black. Now, no matter what layout you are on, we're going to skip over Delta, Gamma, Theta, Vega right now because we'll speak about that when I speak about the layouts. But no matter which layout you're on, you will see a bid and a ask. Bid, of course, meaning what the current value someone is willing to pay for the option. And ask, of course, meaning what the current value that someone is willing to sell the option for. You will see that on both the call side and the put side. And once again, they will always be there no matter what layout you're under. Now, your 9 February 24, this is your expiration date. And this is decided by which options chain you select. So you will notice the option chains here are listed and sorted top down by expiration date. So if you want to look at the 19 July 2024 options, you will notice that all the strike prices here are now 19 July 2024. That just means the day that these options are going to expire. And we can talk about, maybe towards the end of this video, we can talk about sort of what that means, what happens at expiration day. For right now, that's just what it means. That's just what it is. Strike price is showing you the, for lack of a better term, the strike price that you are buying the option at. Once again, if you sell a 700 strike put and on February 9th, it expires and the price of Nvidia is at $695, you then get to sell 100 shares per each contract that you bought at 700, meaning that you made 5 points on the underlying value of the option, right? Although you paid $5, if you bought it right now, you paid $5.50 for that right. So you would actually lose 50 cents in that scenario. So I just said maybe we talk about what expiration date means at the end of the video, but I just sort of gave an example there, and hopefully that helps explain the expiration date and strike price that you're seeing here. Now, before we jump into the layouts, I want to talk about what you're seeing over here on the far right, and it's very, very important. This one is very important for those of you all that maybe aren't even as interested in trading options itself, but are just equity traders watching this video to learn more and to broaden your horizons in the stock market. First off, congrats on you. Great for doing that. But this is going to be a very important column for everyone to understand. This is implied volatility, and what implied volatility is showing is the expected move that the options market is pricing into the underlying asset on the expiration date. So you will notice that each expiration date has a different implied volatility, right? And you may also, the keen of you out there, if you can see these numbers, they might be too small, but if you can see these numbers, you may also notice that the longer out we're going on our expiration dates, the larger the implied move almost always is. And that makes sense, right? You give an asset more time to move, it makes sense that the expected move is going to be larger. What this means is 47%. That means you're getting and this is the more important number. I'm not going to lie. This is the number that I look at more. You're plus or minus 14.95. That means that up and down, that's the total range expected is what I should say. So now it's at 15. Let's use 15. That's nice and round. And this is February 9th. As I'm making this video, that means it expires tomorrow. Tomorrow is Friday. This is a weekly option, meaning it expires tomorrow. By the way, I should mention this. Almost all options, unless you are dealing in dailies, like on some assets and some other stuff, once again, another level, and you'll notice that in the chain. But almost all options are expiring on Fridays. Weeklies are just built closer to the expiration times. You'll notice there's only weeklies up to the 28th of March, whereas there are monthlies, which these gray ones are, all the way out to December 18th, 2026. So weeklies are just built a little bit quicker and rotate a little bit quicker, but all options expire on Fridays. Okay, I'm rambling. I'm getting away from my typical point here. So what was I talking about? Up and down range implied volatility. The current price of NVIDIA is 703.7. The strike at 700 has a put price of 490. That means the break-even price, let's call it 5 for ease sakes. The break-even price on this strike is 695. By February 9th, NVIDIA needs to be at 695, or else you're not going to make money on this because you won't eclipse the amount of equity that you put into the option itself at the time of expiration. We spoke about that when we were talking about expiration dates a little bit earlier, right? So you've got 5 points on this side of the trade. On the other side of the trade, sorry. You have 5 points from the strike, but also the strike is 4 points below the current price. So if the break-even price is 695, that means it is, what does that mean? It's 695. That means it's 8 points away from the current, 695, 705 minus 695 is 9, Trey. You are 9 points away from the current price, so you have a 9-point implied volatility on this side of the trade, right? Then if we go to the other side, once again, the current price being 704, the strike being 700, on your call, you need to get to 709 to be break even because the current price is $9, right? So on this side of the trade, you would do 709 minus 704, which would be 5 points. So if we were roughly 9-10 points on this side, this is a little hard because I'm doing this during market open and everything is changing. This might have been easier to do after market close, but screw it, we'll do it live. So something like 10 points on this side, something like 5 points on this side means that you have your implied volatility of 15 points. Hopefully that made sense. Please, if you have any questions, let me know in the comment section down below. We're dealing with very complex instruments here, and I'm doing my damnedest to explain it as I would to a child. That's how I like to do my tutorial for beginner videos. So hopefully that makes sense. Once again, it is the strike price minus the break-even price on the option that you are taking, which is decided by value plus premium, premium being what you spent on the option. So value plus premium, value minus premium on a put, value plus premium on a call, 709 being break-even, 695 being break-even. Both of those values, how far away they are from the current price, gives you the implied volatility. That hurt my own head to explain. Once again, any questions, comment section down below. If you are interested in custom thinkorswim indicators, strategies, scanners, watch list columns, check out daytradingstrategies.net. Link at the top of the description. We'll see you over there. All right, if you thought implied volatility was complex, wait until we jump into the Greeks, which is what we're doing next. I'm not going to get too complicated in this. I'm going to keep it at an elementary level, and I'm going to explain it so that you can understand, I promise. Delta, Gamma, Theta, Vega are your basic option Greeks. These are the Greeks that you need to understand if you're going to jump into this world, and so that you can understand what the options market is pricing in for the underlying asset of the chain that you're looking at. So let's go over them. Delta is the amount that the option price will change if the underlying changes by a point. So on this 700 strike call, the delta is 63 points. As we know, calls are bullish. So if the underlying NVIDIA currently at 704.91, if the underlying goes to 705.91, this option will go up 63 cents. So it's currently trading at 920. It'll go to 982 or 983, whatever I said it was. Once again, all these numbers are moving as I'm talking, so a little bit complicated, but that's delta. Gamma, maybe the most complex, and honestly the one that I use the least, so I'm not going to be able to explain this too deeply. I do know what it is. It is the measure of rate of change between the delta and the underlying price. So it measures how much the delta has changed based off of what the underlying price has done. This one, like I said, I'm not going to lie, I don't use very much. If anyone out there genuinely has a reason for why you use gamma, why it's super important for retail traders, let us know in the comment section down below. Theta, maybe the most important one to understand if you're going to buy or sell options. Theta is the amount that the option will decay overnight. So these are tomorrow expiring strikes. Once again, tomorrow is the 9th of February, 2024. The 700 strike call currently has a bid at $9.20. Its theta is $3.90. That means if you buy this option at $9.20 and nothing happens on NVIDIA for the rest of the day, not to mention how that would change other Greeks, such as your implied volatility and your Vega and your Delta, and how that might change other prices. But let's just ignore all that. Say you bought it. Say it was almost 4 p.m. It's not. Say it's almost 4 p.m. The market's about to close. You buy it at 9:20. You know tomorrow it's going to open up $3.97, which is, of course, I haven't even spoke about this yet, but if you didn't know, a single option contract represents 100 shares. Therefore, you move the decimal point over twice. So when you see that this costs $9.15, it actually costs $915 per contract, right? So you spent $915 per contract at market close tomorrow, barring an overnight change. Once again, if it opens at the same price tomorrow, you're going to be down $390. That's how much the theta is going to eat into it. Now, if we go further out, let's go to the most extreme. Let's go all the way to the December 18th, 2026. Look at how much smaller the theta is. The theta is only 12 cents or $12 per contract down here because it's further away from the strike price. Distance to expiration is huge as it pertains to theta decay. If you've heard of theta decay, that's what people are talking about, the amount that your option loses. And it makes sense because as you get closer and closer to the option expiring, the extrinsic value of the option, and we're going to talk about extrinsic versus intrinsic value in just a second, if that makes no sense. But the extrinsic value of the option is, of course, going to come down because there's just less time for the asset to make a large move, right? That's what theta decay is. Vega is the... I actually had this over in a note. Sorry. I know what this is. I had to look at my notes. Ignore that. I didn't look at my notes. I knew what this was. Vega, much like Delta, is the amount that the option will change, but instead of how Delta is based off of the underlying price, Vega is off of the implied volatility. So Vega is the amount that the option will change if the implied volatility raises or lowers a point. So if implied volatility goes from, actually, we were looking at it earlier in this video, it was at 15. It's right now at 14.3. Let's just call that a 1 point drop for ease sakes. I don't remember what the price of this option was. And once again, it doesn't only matter on the implied volatility dropping. Of course, if NVIDIA's changed prices, blah, 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 blah. But since implied volatility has come down a point, the option, the 700 strike call, has lost 15 cents, $15 per contract, because that is the Vega of the contract. Those are your basic option Greeks. Hopefully that made sense. You now should understand delta, gamma, theta, vega. Next, I said we were going to talk about intrinsic versus extrinsic value. So if I click on this layout here, I can switch, obviously, to what columns are showing. If I go to position, intrinsic, extrinsic, your position, of course, would show if you had a position. I don't, so nothing's over there. But your intrinsic value is the amount that the strike price is away from the underlying. So the intrinsic value of a 700 strike call is $4.65 because NVIDIA is trading at 704.65. That is the literal value of the option. That's the literal, don't take any of the Greeks that we just discussed into an account, value of the option. Remember, a call is the ability to buy 100 shares per contract at the strike price. So if it expired at 704.65 and you have 700, that means you make $650, right? Because you get to buy, it would exercise, you would buy 100 shares at 700, they'd be worth 704.65. Congratulations, you made, I think I said it wrong. I think I said 600 something. You made $465. The extrinsic value is the difference between the intrinsic value and the premium on the option. So the premium on the option is $9.40 right now. That's the ask. That means, so if you have the ability to buy 100 shares at $700, but you're paying a $940 premium to do that. That's what the extrinsic value of an option is. So the extrinsic value is, once again, and this is getting complicated because it's changing, but now the intrinsic value is at 5, let's call it, because NVIDIA is at 705. The extrinsic value is 426 because the bid is at 930, meaning you need to get above the intrinsic and extrinsic values to make any money. Does that make sense? The intrinsic is the literal value difference, the literal strike price to asset price difference. The extrinsic value is the premium that you are paying based off of all these Greeks and the implied volatility that is adding value to the price of the option. That makes sense? Once again, any questions? Comment section down below. All right, this video is starting to get a little bit long and a little bit complex, and I want to apologize for that, but hopefully this is what you wanted. Hopefully you clicked on a video like this wanting to dive into these complexities of the options chain. And where I'm struggling a little bit is trying to explain this stuff at a very beginner level, because as you may or may not be able to tell, the options chain is not beginner level stuff. This is very complex stuff. If the stock market is the most complex trading platform in the world, then options are 100x leverage of that. And not only that, you're also adding extrinsic value, such as the Greeks and the implied volatility and this, that, and the other on top of it. So this stuff's very complex. Hopefully you're finding value in it. Hopefully I'm doing a decent job of explaining it so you can understand. With all that being said, I want to jump into just one more layout here, and that's going to be your volume and open interest. Not going to insult your intelligence. You know what volume is. Open interest, though, this is the amount of contracts that were open at this price coming into the day. So the 700 strike calls on NVIDIA for February 9th, they expire tomorrow, today being February 8th, but coming into today, so at open on February 8th, there were 23,741 of these already open. That's what open interest means. And people will use this. Let's just jump down to the 20th of September, 2024, and let's show like 25 strikes or something. People will use this. They'll come look and they'll go, oh my gosh, look, for the 20th of September, there's 1,100 open interest at the 800 strike on NVIDIA. I'm not saying you should do this. I actually really don't like doing this because there is a ton of reasons for people to own options, right? We talked about spreads a little bit earlier, and even though we didn't dive too much into it, just because someone owns calls doesn't necessarily think that they mean that doesn't necessarily mean that they think that the underlying asset is actually going to go up. They could be using it as a hedge. They could have built a very complex put spread that just required buying some calls. So I don't love the idea of looking ahead at open interest, but you'll hear people doing that sometimes and talking about that. And I want you all to understand what they're talking about. So people will look once again at the 20th of September. Oh my gosh, there's 1,100 open interest on the 800 strike calls. That must mean this, that, and the other. Once again, I don't suggest you do that. I don't like doing that. I don't like all the option flow traders out there, once again, because the assumption of most option flow traders, at least beginner level option flow traders, is that everyone is trading in singles. Everyone's buying calls thinking the stock is going to go up, or buying puts thinking the stock is going to go down. And I promise you, that's not true. Options were created. Options exist because funds wanted a way to hedge their investments. The big money boys, and I don't know this, I've never worked at a central bank, but I can promise you are almost never trading single options. They are building very complex spread plays. They are building very complex hedges. They could have a massive short position on NVIDIA, but they're buying 800 strike September 20th calls just as a hedge against that. Just in case they're wrong, they'll still get close to break even on their hedge, right? So option flow and open interest doesn't necessarily mean someone thinks NVIDIA is going to be at 800 on September 20th. Hopefully that makes sense. Hopefully you understand what open interest is. Let's jump down to the next section of the options chain. Alrighty, let's get down to these final 3 sections of the options chain down here. Still very important stuff, but let's try to get through them relatively rapidly here so we can get this video done and wrapped up with. Today's option statistics. This is obviously where you can see total volume, and this is very important. You can see really what is the sentiment of the market on this equity today, on this asset, whatever you're looking at, be it futures, be it indexes, be it equities, whatever it is. I mean, look, NVIDIA is up. I mean, first off, NVIDIA is an absolute monster right now, and it's up 0.5% again today. And you can see there's 576,000 calls traded today, only 376,000 puts. Obviously, the option sentiment today on NVIDIA is bullish as well. That's how you can use this. Now, this little column over here, also very important for this reason. You can see your 52-week implied volatility high at 70% or 0.7 decimals. 52-week IV low at 32%. And then you can see at the bottom here, what does it say? Here, it says your current implied volatility is 53.67%. Don't ask me why they show this in decimals and this in percent. I don't know why, but you can see And this is where you start to get the idea of when's the best time to buy options and when's the best time to sell options. Now, I'm not telling you how to trade, but if you want to buy low, sell high, it makes sense that when the implied volatility is down, the price of the option is going to be cheaper, right? Because high implied volatility builds in to the extrinsic value. And we talked about that with the Greeks earlier, right? So this is an important statistic to look at. Right now, you can see it's sort of middling. The 52-week lows at 32%, the 52-week highs at 70%. Right now, the implied volatility is at 53%. If you saw this implied volatility at or near the 52-week low, you could go, okay, hey, NVIDIA's really not been volatile lately. It might be a good time to load up on some cheap options. Then if that volatility comes in and IV goes through the roof again, the options, no matter what, I mean, not no matter what, but are likely to go up in value if you pick the right direction or if you built the right spread. So blase, without ranting too much, you can hopefully see where this comes into value. And then this stuff over here on the right, which I understand you can't see, I believe this is a Thinkorswim specific thing. Someone let me know if I'm wrong on this, but this is the Sizzle index, and 100% clarity, I'm not 100% sure what this is. It's something to do with like today's volume versus average volume. So the today's Sizzle index is 0.96. That means that the day's volume is a little bit less than the average volume. But your put Sizzle index is 1.043. So actually maybe people are buying a little bit more puts today than they have been recently. I'm like 90% sure the Sizzle index is something like that. But anyway, let's go down to the next section here, and that is options time and sales. And just like equity time and sales, this is just, you can see in real time what options are being traded. That's what time and sales is, just like it is on equities. We don't need to touch on this for too long. This last one here is about to look crazy. If your mind's been blown so far, if you're what, 30 minutes nearly into this video and your brain hurts, wait till I open this last section here. Product depth. Woo! This is where you can come in and you can look at how different values, and we've touched on a lot of these values today, how they would be different at specific strike prices. So right now, you are seeing every options chain. That's what this all means, that's what this all 22 series here means. So say we just want to trade the options expiring tomorrow. If I just check the 9 February, that makes it a little bit more clean. And you can see now, okay, if by tomorrow, or I don't even know if it's if by tomorrow or if it would be right now. I think it's if it would be right now. If the price of NVIDIA, and it's freaking out, it's loading in, but if the price of NVIDIA went to 840, the implied volatility would be at like 200%. And of course it would, because that would be crazy. Let me show you another. It's still loading in. Sorry, it doesn't normally freak out like that. It's not going to give it time to load. If I load up theta, this is the best way I can explain this to you. So right now, the price of NVIDIA is 704.38, which is pretty much represented by this peak. That is where theta is the highest. Do you all remember what theta is? Quick pop quiz for you. Theta is the amount that the option is going to decay overnight, the amount that the value of the option is going to lose overnight. And that's the highest at the current price. And that makes a lot of sense. Think about that, because the value of the option at the current price is the highest, especially on an option expiring tomorrow, right? If we go look, let's load all, and let's look at the theta. I mean, look at these options. These options at the 490 strike, flipping whatchamacallits, puts are at 0, because no one believes Nvidia is going to be at 490 tomorrow. Therefore, the theta is at 0. There's really nothing to lose. And you notice as you get closer and closer on the puts, the value of the puts get more and more and more and higher and higher and higher. Therefore, the theta, the decay, gets higher and higher and higher. And you can see that the other way out on the out of the money calls as well. As you get closer and closer, value goes up, theta gets higher. As you get further away, theta gets lower, and that is represented, and that's a decent example of your product depth down here. Obviously, all kinds of crazy stuff you can jump into in here and really mess around with if you really, really want to get intense on this stuff. But that is the options chain. That's how you read the options chain, at least at a 101. I would even say we dive into some like 201 level complexity in this video, talking about, you know, how extrinsic values will change based on strike price and expiration date. So you got a little bit of extra value, hopefully, out of this video as well. So if you found value in it, which if you made it this far, you must have, please like the video. It really does help. Make sure you're subscribed. You know, over 68% of you watching right now aren't subscribed. That's crazy, especially if you've made it this far in the video. You must enjoy me yammering on at least a little bit. And I'm making these videos just about daily for free on this YouTube channel. So make sure you're subscribed. Once again, if you're interested in all of my custom thinkorswim codes, daytradingstrategies.net, link at the top of the description. We'll see you over there as well. With all that being said, I'm going to go ahead and wrap up today's video, but I will link you all to a video that is my thinkorswim tutorial. So if you've watched this video and you're maybe not already using thinkorswim, but you're considering a platform, check out that tutorial video next.
Trading stocks. He talks about trading stocks. It's important for you Americans and other international individuals to learn about stocks.